Hi, everyone, and thank you for joining us. I'm excited to welcome Zachary Mans, who is the co-host of the Stock Waves and the mining stock service within the LAWaveTrader.net platform, as well as Garrett Patton, a technical analyst and chief educator for LAWaveTrader.net. Gentlemen, thank you very much for being here. The floor is yours.
Thank you, Stephen.
Thank you.
So Garrett and I are joining you guys today to talk a little bit about our view of the metals and mining stocks, as well as some of the agricultural stocks that softs that we see having some good potential over the next year or so. And these are things that we cover regularly in our metals, miners, and agricultural service as part of the LAWaveTrader.net website. And we use an approach looking at things from the standpoint of Elliott Wave and breaking things down at multiple degrees to provide lots of layers of analysis that our subscribers can use for formulating their own trade plans. So we are bullish. We were bullish, coming into the middle of the year or end of last year as we were filling out this larger consolidation in gold. And really like the price action that we have off of the low and see that as just the start of a bigger swing move that could potentially last for another 2 or 3 years, maybe, depending on how the smaller degree pattern inside that unfolds. Elliott Wave, in the most simple terms, is a way of assessing price patterns based on investor sentiment. And those patterns are usually comprised of 5-wave moves or 3-wave moves, advancing and then correcting the overall pattern. And it's fractal, meaning that it repeats at different degrees and at many different time frames. So within the larger structure of a single move, you can see that same DNA of the 5 waves up or the 3 waves down, or vice versa if it's in a bearish pattern, unfolding at the smaller levels inside. So that's one of the things that we use to look for confirmation. So we know that we want to see this big swing move up, potentially heading towards the 2,500 region for gold. And we know that that should be a 5-wave move, 1, 2, 3, 4, 5 in the parentheses notation. For subwaves, that's intermediate degree. And we know inside each of those that we should have 5 waves up and 3 waves down. But when we look in a little bit closer, we see that we're in the general region for resistance at the smaller degree inside this bigger swing wave up. So we can start to see some consolidation patterns. And that's where we zoom in and look at a little bit more detail to see, okay, what do we have off of the low in terms of those same 5 waves up and 3 waves down patterns. And we can see that we don't yet have a clear 5-wave move to the upside. We have 1, 2, and 3 waves up so far. And depending on how you count this, it can be a more complex pattern. But essentially, to get 5 waves up, we would either need to get a 4th and a 5th wave, or we're looking at some sort of slightly different pattern, which could take things, drag out a little bit longer in time, where all of the moves up are ABC moves, which that gets a little bit more complicated. But essentially what we want to see is some consolidation to give us a lot more clarity and provide a level of support for the next swing moves off the low. So we have looked to lighten up a little bit of exposure, but at the end of the day, we are still very, very bullish on the years to come. Now, silver is a very different pattern because it made a substantial lower low in a much bigger retrace at the end of September. It did not hold as the same kind of higher level 4th wave consolidation that gold did, but it does look very, very constructive off the low. So this is a much more zoomed in pattern, but ideally we would see a similar 4th wave and a 5th wave up to complete that first 5 waves move up off the low for a wave 1 in a larger swing move that we're looking for in silver. And when we move on to look at the miners themselves, we can see a lot of similarity there. Although GDX, which is probably the better index for looking at miners over the Huey these days, can certainly count as 5 waves up already. I would probably prefer to get another 4th wave and a 5th wave up inside that larger wave 1 but any consolidation that we see here could be very, very beneficial. And one of the things that I wanted to bring your attention to before we look at some of the other mining sectors in the metals is that in some of the consolidations, the moves up off of significant lows, the consolidations have been very, very mild. But those reversals were much sharper, certainly 2016 off of the low there and off of the 2020 low. So the consolidation that ended up counting as kind of that nice move to set up the next swing was a lot more shallow and less clearly defined than some of the other consolidations that we've seen. But what we have off the low here is a little bit more pronounced as clear wave structure. Again, I would like to see that fourth wave up and a fifth wave before we get a larger wave two in this bigger swing move that we feel can be targeting the high 70s and maybe even into the 80s. For GDX, which is the second half of the move off of the 2020 low. But this might be all of that wave one already, and any consolidation we get could just be all of the wave two. And then instead of stopping at the next resistance and getting another bigger consolidation, we can just break out from there. So we will certainly be looking to add a lot more of the wave setups, which are where we point out individual names or maybe sometimes some sector ETFs if it's in the Stockwave service with very, very clearly defined risk reward parameters outlining a target and resistance levels and support and invalidation levels for a given swing move. Before I turn things over to Garrett, I also wanted to take a quick look at TXGM. This is a different index. It's a Canadian mining stocks index, but we look at it frequently because it has a lot more, it's a lot closer. It's not an equal weight because a lot of the mining stocks are very, very small, but it is closer to a more diversified mix of a lot of the mining companies. And again, we can have this possible 5 waves up for all of wave one, and any consolidation we get could be all of wave two. We might be able to get that fourth and a fifth wave higher, but looking for a similar longer term swing that can take the better part of another year or two up towards the 190s to 200 region would be the normal target for that. If we do get a larger wave one first before it gets consolidation of wave two, it might push that to the next Fibonacci confluence levels all the way up to the 230s. Garrett, did you want me to take a look at copper and platinum, or you wanted to do those along with the softs?
Yeah, you can go ahead and take a look at those, and then I'll take a look at the agricultural commodities.
Okay, so copper is a little bit more interesting because it got what can count as 5 waves up off the 2020 low to just shy of a measured move. It got a little bit close to the 764 extension, which for a lot of times as a C wave, that's all you need, even though our standard, we look for the C wave to be a 100% or an actual exact measured move to that A wave. So there is some more bearish concern on copper. But I would like to see the support hold in the mid 3s and get a move back up towards the 6s. But we are in a very interesting spot of resistance here. So as we said, most Elliott wave moves are 5 waves up and 3 waves down is the way that they start. Not all of them start that way. But generally, when you have only a 3-wave move, your initial concern has to be that that is part of a corrective consolidation and that you're going to have a new move in the opposite direction. So far, we only have 3 waves up into resistance for copper. So it is very, very important for any consolidation that we get to be clearly a corrective consolidation and hold normal fib support, or copper could be a lot more bearish than some of the other metals imply. And then looking at platinum, we do feel has started a much larger degree bullish move that can take several years to fill out. But it is one of those more complicated Elliott wave patterns where things are moving in corrective ABC moves. So this is even though this is a third wave, instead of the subwaves inside of this third being 5 waves up, it's only an ABC move. So it does mean that there's a little bit extra complexity and room for some chop and back and forth. But off of the low that we had in September, let me hide this so it doesn't get in the way, we do have what can count very nicely as 5 waves up off of that low. So we would like to see more of a corrective consolidation fill out in platinum, and then that can set up for another swing move, a measured move, or maybe a little bit more towards the 14 or 1500 region for platinum. Now I'm going to turn it over to Garrett, who's going to go through some of the agricultural softs, and then we'll certainly leave some room for questions.
I think you just have to stop sharing your screen.
Got it.
All right. Hopefully you can all see my screen now. So as Zach mentioned at the beginning of the webinar, we recently expanded the scope of coverage in our metals and mining service to also include analysis on a lot of the agricultural commodity futures charts. So there are some pretty decent opportunities that seem to be setting up on some of those individual futures charts for those agricultural commodities going into this next year, into this year, into next year as well. That could be some pretty decent opportunities for those interested in taking advantage of them. So first up, you can see that I have cotton pulled up, which does support a correction now complete off of the high that was made last year into the recent October low here. So this can be just the start to a new 5-wave structure. Those 5-wave structures, as Zach was discussing earlier in the webinar, as the type of moves that we like to see as far as advancing price within the direction of the larger trend. So with this initial move up off of that October low, again, it looks like just the start to a new 5-wave move to the upside. So you can see this label as wave 1, and price currently consolidating in what should be wave 2 of that 5-wave structure. That does have room for a little bit more near-term downside to test these fib support levels. So it could head down to this 50% retrace that's based on the size of the wave 1, or maybe even that 618 fib at 76 before the correction completes and then turns back up in the starts to the wave 3. So there's some decent risk reward opportunity using either if you want to use a stop below the October low for full invalidation, or maybe a little bit higher, you could use the 786 retrace at 72.78 for a tighter stop to position for that turn back up in the wave 3. That should then go on to fill out a full 5-wave structure to the upside on cotton. So again, viewing the correction off of last year's high complete into the October low, and price turning up in the starts to a new move that eventually, again, this is going to take some time, but eventually can take price back above the high that was made last year. Another opportunity that we're currently eyeing is on coffee futures, which also is looking like a correction from the high that was made last year has completed. Now, as you can see, price has not really made the same sort of progress off of the more recent low that we have on the cotton chart. So a little bit more confirmation of the bottom in place is still needed here, but we do have what looks like a complete corrective structure into important fib support, the 618 retrace. This is measured based on the size of this wave 3. So we're looking at the 4th wave within this larger 5-wave structure off the 2019 low, nearing completion to get ready to turn back up to new high in the 5th wave. So ultimately, a break back above the high that was made at the end of December is going to be needed for confirmation that this wave 4 has completed. But as far as trading purposes go, that doesn't necessarily mean we need to wait for that confirmation. There is still good risk reward using a tight stop below the recent low to try to catch that bottom. But again, for a more conservative approach, you might want to wait for a little bit more subwave structure off the low, a little bit more evidence that the bottom is already in place there. Another potential bottom forming is on the lumber chart, which also can count as a correction complete, in this case, off of the high that was made in 2021. We just recently got a pretty decent sized gap to the upside. I think that was last week. That certainly has given a big boost to the probability that a bottom is indeed in place here, that the correction off of the 2021 high has completed. And price already starting to clear some of those recent highs that were made back in December is kind of initial evidence of a near-term trend change. The next main hurdle for price is going to be clearing the October high for further confirmation of that bottom in place. But again, some pretty constructive price action so far off the recent January low that certainly argues for a bottom in place and forming here to set up a next sustainable move to the upside, which again, in this case, can eventually, it's going to take some time and obviously not in a straight line, but take price back above that high that was made in 2021. Next up on sugar, this chart has certainly been holding a much higher level of consolidation in comparison to the other charts that we've looked at so far. But it seems to be still setting up more near-term upside and potentially has completed the more recent smaller degree correction into the January low as a smaller 1-2 off of the September low in a large degree fifth wave that can set up some further near-term upside to take price up into the, I would say, probably lower to mid 20s before that fifth wave would look satisfyingly complete. So another fairly defined risk reward setup using a stop underneath the current low in the month, where wave 2 should have completed and price turning up in the starch to this wave 3 of 5. Let's take a look at wheat. Next up on the wheat chart, in this case, price has not clearly indicated that the correction down from last year's high has completed, and there is still room for further downside before price would look more satisfyingly complete with an ABC structure with that three-wave move that we look for corrective structures to take shape as. A little bit more room for further downside before that looks more convincingly complete. So in this case, we can see price continue to fill out this C wave with that 764 fib at 607 as a possible target to reach before the correction completes. Price would otherwise, at the very least, need to get back above the high that was made at the end of December to open the door to the possibility of being more immediately bullish. Otherwise, again, it looks like further near-term downside for the subdivision lower is needed before the correction here ends up completing. So a little bit more patience likely needed on this individual chart. Corn is somewhat similar where it isn't as clearly immediately bullish. Although it is being currently stubborn about follow through to the downside, assuming the price has not completed a large degree correction and needs for the downside before setting up the next sustainable move higher. There is the potential for an immediate drop lower as long as price is maintaining below the December high here, as far as what can be a 1-2 start to a 5-wave structure to the downside off of the October high within that large degree correction. But this current setup to the downside within the start to that wave 3 requires price to maintain below that December high. Otherwise, the next option would be the wave 2 still in progress that can head up and test that 764 retrace before attempting to turn back down again. So as you can see, there are some individual commodity charts that don't look as clearly immediately bullish that would benefit from some more near-term downside. As opposed to some of the charts that we were looking at earlier that, again, look much more convincingly immediately bullish in comparison. Taking a look at soybeans next. Give that a second to load. Soybeans do look like they can see more near-term upside but it isn't, in this case, clearly setting up a trip back above the high that was made last year. It looks like this can still be the current upside off of the August low last year, part of a larger correction that is still in progress from the February high last year. So another three-wave structure where this is just the A wave down, working on wave B, and then that can be followed by a C wave before that corrective structure completes. But within that ABC structure, the B wave still has room for more near-term upside, a little bit further subdivision to the upside before turning back down in that large degree C wave. I think that covers most of the commodities futures charts, unless there's one that I'm missing. Otherwise, we can open it up to questions now, if there are any.
All right, thank you guys. We appreciate that. That was a great presentation. So our first question, could you tell us your thoughts on natural gas, please?
Yes, it is something that we don't cover as extensively within the metals and mining service. It is covered more regularly in the main market service of our website, but we do occasionally post a chart in the metals and mining service in regards to natural gas, just again, not the main spot where that is normally covered. But natural gas has been working on a correction off of the high that was made last year that should be getting fairly close to completing. We don't have evidence of the correction complete just yet, and there is the potential for a little bit further subdivision to the downside. Before that correction completes, we have to treat a bounce from here as potentially just being a fourth wave within the C wave to set up another lower low as wave 5 of C before that correction completes. It did come all the way down at the recent low to test a 618 retrace, measured from the 2020 low into last year's high, based on the size of this 5-wave structure to the upside off that 2020 low. So from a fib perspective, it has pulled back and retraced a pretty common amount of that 5-wave structure into standard retrace support, where we often see corrections complete, bottom form. But again, the subwave structure here, not as convincingly complete. We could still see one more 4-5, but at the very least, it does look like prices due for a near-term fourth wave bounce. That can take it back up to the target range for that fourth wave would currently be between 423 and 509. So either price would need to clear that resistance range to prove that this is more bullish than a fourth wave, the correction already complete, or produce a convincing 5-wave structure off of the low to otherwise support a bottom already in place. Are there any other
Alrighty, sorry
questions?
about that. And our next question from David, do you have a forecast system?
I'm not entirely sure what is meant by that question. The method of analysis that we use for our service is Elliott wave theory. It's something that you can pretty easily find information on with a quick Google search. Otherwise, we have a lot of educational materials on our site that are free to the public as well. But that is kind of our approach to analysis on these charts, is using Elliott wave theory.
There's the Ralph Elliott created a system of rules for viewing price patterns that can be applied and then incorporated with Fibonacci extensions and retraces, and then as well as some other technicals. Some of it is subjective, but the rules are easy enough to learn. As Garrett said, we have a lot of educational material. The charting software that we use is Motive Wave, which is very excellent software for anybody who's trying to learn or practice Elliott wave, as well as just other great charting software in general. It does have an auto counting feature, but we found many irregularities and inconsistencies when it's used. The thing that we use pretty commonly, though, is a nice shortcut tool. Is once you have a larger degree labeling in place, you can click on that to decompose it into the subwaves. And most of the time, that's generally in more or less the same spot where Garrett and I would place things. But as I said, there's is a subjective component to it where we've developed what appears as the right look. And so even though something can technically follow the rules, it may not look right.
Alrighty, thank you. So next question from Andrew. For the spot gold price, does the lack of price strength and momentum in your third wave from November to now bother you? Usually third waves are very strong with a high angle of appreciation.
So I didn't go into as much detail there, but you can see the structure that Garrett has in blue is the way is my primary way of counting it also, where it is a diagonal pattern. So it is a third wave because it's in the third wave position as part of a 5-wave move up for that larger parentheses wave 1. But it is corrective and choppy in nature and subdivides in at the smaller degrees in ABC. So that's inside the structure we call leading diagonal, which a lot of times does set up for a very, very powerful move to follow. But the internal structure of a diagonal sometimes still has remnants of the previous consolidation and correction at the larger degree. So there's a lot more chop and uncertainty as you kind of build on a pattern and build that stronger base off the low. If we ever get around to writing a book with Avi, one of the sections that Garrett and I are gonna look at is where things like leading diagonals appear in conjunction with other technical analysis patterns. Like maybe that's kind of the lead up, and where you get like a cup and handle is because maybe if you look closer at the Elliott wave structure there, you are seeing like a leading diagonal fill out that takes a longer, choppier price pattern to kind of get a more rounded bottom. Then it gets a retrace, and then it just takes off.
And it's been, a pretty strong move, I think, off of the low that was made last year so far. Definitely doesn't look bearish at the moment. I guess we do want to see that near-term pullback as either a fourth wave or wave 2, but nothing about this price structure off of last year's low is really concerning yet, regarding the expectation that it eventually will be heading back above the 2022 and 2020 high.
All righty, thank you. If you don't mind, what's your favorite chart among the miners?
Some of the favorites, a lot of the larger cap ones are looking pretty promising overall. We like AEM, we like NEM, we like GFI. Some of those large cap ones do, again, look like they are set up in a similar bullish pattern that can take price back above the high that was made last year, as well as the 2020 high.
I mean, our subscribers ask us those questions all the time, and which is why we preach a lot of diversification. We preach the strength of a setup and the clarity of a chart, sometimes over just the potential percentage gains. So that we do look at some that are smaller cap companies that don't have the cleanest wave structure, but do have huge percentage potential. And you could say, those are great because of the huge percentage potential. But a lot of times Garrett and I would much rather have the certainty of clearly defined subwave patterns than, looking at things as a speculative lotto. Now, we certainly keep some of those in our portfolio because, mining stocks love to shoot for the moon once all the conditions are right. And we can have a mixture of those in there. But as Garrett said, the Barricks, the Newmonts, Barrick, GOLD really looks almost identical to the gold chart. So, it just gives that added level of clarity to the way that we're counting both, seeing those subwaves, sync up so nicely.
All righty, thank you. And what's your analysis on crude oil and the short and long term, please?
That is something that we cover on our site on elliowavetrader.net, but not really the focus of both the service or this webinar.
All righty. How much do you use momentum oscillators to complement your analysis?
They're definitely tertiary to Fibs and Elliott Wave price structure. but we do use them to help confirm or at least support specific counts. So for example, within what should be the strongest portion of an impulse, the third wave, we like to see, the technicals match that, not see any negative divergence to disagree with what should again be the strongest portion of that specific structure. So it's not what we base our analysis on, but we use it again as supportive to that analysis.
All right. Well, thank you, gentlemen. That's all the time we have for today, but that was a fascinating presentation and we really appreciate you joining us.
Thank you, Stephen.
Thank you.
Happy to be here.